Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be taking a look at a slightly different context. This one is going to be talking about stopping the focus on dollars and cents. And I know that's significantly easier said than done, but one of the biggest issues that a lot of traders have from a staying in a trade or getting out of a trade too early or getting out of a trade too late, it comes down to a psychological barrier more often than not, and a lot of times, once you get through all of the little nuances, it comes down to the dollars and cents, right? We have a hard time looking at a trade and saying, okay, well, I'm losing $300 on this trade. Well, as humans who live in this world of ours, right, on the current planet Earth in 2021, we have a value associated with that. We know what $300 buys in our world, in our environment. So when we place a trade and we know that we're risking $300 on that trade, it has this psychological impact, and the goal is to get around that, and eventually, with enough practice, you can get through the dollars and cents. But it still messes with your head a little bit, and I like proposing a different mentality to get around that structure, and that's stopping the focus on dollars and cents and converting your account into ticks. Now, everybody's account size is going to be different, and that's the kind of beauty about this, is it's adjustable for the market per the account size. So let's say, as an example, we trade on a 200 tick chart on the MNQ. So let's modify this to a 200 tick, and this will give us a little bit more of a realistic representation of how we're approaching the market in the room every morning. Now, from this perspective, let's say, as an example, that we have a $2,000 account. Right? So a $2,000 account, if we're looking at the MNQ, the micro NASDAQ ticks in 50-cent ticks, right? So we take that $2,000 account and we divide it by 50 cents. That means that we have our account size based at 4,000 ticks. Now, on that account size, I don't like risking more than, well, no more than 5% at a maximum, and preferably no more than like 2%. And if I had a preference, half of 1% is where I like to land. From a half of 1% risk, it creates a psychological perspective that means that your risk is so small on the overall account size that it's very easy to psychologically stick with things, and that's where I like to land. So let's utilize that first and see where that puts us. So if we have a $4,000 account, and we want to risk half of 1%. We can take this, right, times 0.005. That's half of 1%. And that means that our overall risk is 20 ticks. So on this, if we were to look at the overall market and say, as an example, that I wanted to find a location to short underneath a nice little bear bar. Let's zoom in a little closer here. Just a straightforward one. Here's a nice little second entry. So let's say, as an example, I wanted to short underneath this bear bar, and we were to look at this from a dollars and cents perspective over to ticks instead. This means that my risk here would be 17 ticks. So I know that from a half to one risk reward, or sorry, I keep saying half to one, a half of 1% risk versus reward, I know that this fits where my risk needs to be. We're at a 20 tick risk maximum. If I'm looking to risk half of 1%, this needs 17. Perfect. Now, as far as downside objectives go, if I'm going for a 2-to-1, 3-to-1, 4-to-1, whatever, that's really easy to figure out too. But the cool thing about this is, now, if we look at this from a psychological perspective, right, let's say that this trade didn't work and it ended up being a loss. What does that do to our account? Now, if we were to look at this in dollars and cents, right, now granted, this is the micro, but if we look at this in dollars and cents, and I lose $8.50, I know what $8.50 is. It's like a small meal for McDonald's, you know. But still, I have a real life value of that. I know what that is. But if I were to look at this in ticks instead, right? Instead of a $2,000 account going down $8.50, which, by the way, this is why I like the 0.5% risk, because even from a dollars and cents perspective, that's a really easy loss to stomach. But if we even take this further and we look at it from a 4,000 tick perspective, if that's $8.50, right, that would be, what, 16, 17 ticks? So 4,000 minus 17, right? This minimizes it even further. Now you can look at it like that thinking, wow, you know, okay, if you end the day and you lost 17 ticks, and you're like, oh, well, 3,983 ticks left, you know, what's the big deal? It's very easy to psychologically stick with the trade with that mentality. So that's kind of the idea of looking at your account in ticks. It's a way to minimize the overall risk that you're looking at. And you can also see how much you can actually afford to risk. Let's look at just a little bit of a shift in gears, and let's take that same $2,000 account but apply it to the S&P, right? The full-size mini S&P. So we have a $2,000 account. The mini S&P ticks at $12.50. So you remember the last one, we had 4,000 ticks available to us for our overall account size. But if we take this to a mini market on the S&P, we have 160 ticks available. That's why I really like this, because it puts things into perspective. Like, wait a minute, what? I had 4,000 ticks available to me, and now I have 160? Why? It's too expensive. It's not worth it. Because if I were to look at this from a risk perspective, 0.005, that means that I can risk not even a tick. Can't even risk a tick on it. Doesn't even work. So this really helps puts things in perspective and really keeps things realistic in what you should be risking, the markets that you should be trading, the markets that you maybe shouldn't be trading. And it really goes to show from an overall perspective how much flexibility or the lack of flexibility you have. And then once you get beyond that point, from a psychological perspective, if you are trading, 17 tick losses on 4,000 overall ticks, that's very, very easy to psychologically take. Plus, you're disassociating from the dollars and cents. It's a little bit of a different. You don't know what the real world value of 17 ticks is. Like, I don't know what that is. Who cares, And again, looking at this from a scalability perspective, as you go in and you start growing your account and you get better and better and better and better, and your account grows and grows, you can start migrating to different markets. And again, then you could look at it where, maybe that $2,000 account is now a $20,000 account. Well, that's a totally different scenario. Now I have 1,600 ES ticks to work with. That's still not 4,000, but you get the idea. That's the goal. So this is scalable to any market you want it to do, and it makes it really, really straightforward and easy. Plus, the key, it disassociates the dollars. Hopefully you found this one useful, interesting, and maybe something you can add to your tool belt. If you have any questions, you can always shoot me an email or drop them in the comments below. Email is jhb@ssftg.com. Until the next one, have a great one, and we will see you all then. Thanks.